Have you ever wondered why a bank with thousands of crores in profit can collapse overnight? And why the investors in so called safe bonds lose everything even before the shareholders? In this video, we are diving into the real structure behind these banks. You will learn how the banks raise capital, how the capital can vanish, and why some banks fall while others survive. And yes, we will use real stories from S Bank to Credit Suisse to Silicon Valley Bank and SBI to break it down. Meet Safe Bank for our example. This starts with 100 crores of founder capital, and this is called as Tier 1 capital, which has core equity. This 100 crores, think of it like a shock absorber in the car. If the road gets bumpy, this takes the first hit. Safe Bank then collects 900 crores in deposits. That is your money. Then it starts lending 800 crores in home loans, credit cards, and business loans. But here is a catch. If the borrowers does not repay, but still the depositors should get back their money. So who takes this loss? That's right, the bank's own capital. Now let's move forward to understand the bank's capital structure. Bank's capital structure is divided into different layers. Tier 1 is spine. This includes common equity tier 1 or CET1, like our 100 crores, permanent, strong, and loss absorbing capital. Then comes 81 bonds. 81 bonds are called as additional tier 1 bonds. They are risky and high return instruments. You can also say high yielding instruments. This looks like a debt and acts like an equity in crisis. Then comes tier 2. This is backup padding. It is useful but not the strongest of all. Think CET1 as your helmet, 81 as your elbow pads, and tier 2 as your backpack padding. And globally, banks are measured by using Basel III norms. These are the international fitness test for the banks. It checks how much muscle does a bank have for every $100 of its risk. Let's go real. S Bank in 2020, depositors of S Bank were panicking. Share prices crashed. Regulators stepped in. To save the bank, they wiped out almost 8,400 crores worth of 81 bonds. These bonds were supposed to be safe, but 81 comes with a warning label. In crisis, you could lose all of it. Investors were very furious, but legally, Yes Bank had all the rights. Now, you may think, why banks aren't like companies? In any other company, if the company falls, shareholders lose. But in banks, you lose, I lose, because banks work with our money. That is why regulators force banks to maintain strong capital. It is not just to protect the bank, it is to protect the public at large. Now, let's shift our focus to Credit Suisse. A 167-year-old bank, in 2003 it collapsed, but this time something new happened. 81 bondholders lost everything. What is this 81? 81 is additional tier 1 capital. 81 bondholders lost everything. But shareholders got small payout. That flipped the hierarchy. Traditionally, shareholders go down the first, and not here. The market was shocked. 81 suddenly felt like a trap. Now you may think, which of these capitals are safer, whether it is CET1 or AT1. CET1 represents a strong capital which is permanent in nature and never vanishes unless the bank does. While AT1 is a hybrid, it feels like a bond and can vanish like an equity. Although AT1 pays a higher interest rates, but the risk is way higher. In crisis mode, it is the first one to go. So when you invest, know where your money sits in the stack. Now let us focus on another big bank in recent times, Silicon Valley Bank in 2003. This bank didn't have any bad loans. It invested in safe US government bonds. So what went wrong here? Interest rates rose up and the safe bonds fell in value. Customers panicked. They started withdrawing their money faster and faster. Silicon Valley Bank could not sell their bonds quick enough. Result, a classic bank run. The lesson out of it? Liquidity is always greater than safety. You would need money to move faster in the crisis. Now, let me bring back to a Indian context. The IDFC First Bank had a risky start after merging with Capital First. Losses hit the capital ratios. What is the solution? The brilliant Vaidyanathan thought of reviving back this bank and planned to raise the fresh Tier 1 capital. It is painful in short term but necessary to build the strength. Think of it like hitting a gym after an injury. Though it is tough, but it is worth it. Now on contrast, that is SBI, which is the biggest bank in the country. It has higher CET1 ratio and lower AT1 exposure and lots of liquidity. During the COVID, while all other banks were panicking, SBI stayed calm. There was never a deposit fight, no bond blow up. It just maintained the stability. So now can you tell what makes a bank a strong bank? So here is the bank's strength checklist. The bank should have higher CET1 capital. Think of it as a strong bones. Secondly, lower AT1 exposure, less risky in times of troubles. Thirdly, a bank should have a strong liquidity, which is like a fuel in a tank when the fire starts. And finally, a transparent balance sheet with no surprises. So, next time when you hear the bank made 100 crores in profit, don't just look at profits. Ask how much capital does it really have? How liquid are the assets? And where is your money in this capital stack? If you have found this video insightful, like it and share it with your friends. And subscribe for more such finance stories that actually make a sense.